Wasting money on cures. Forgot how to fix myself. They say that time is free. Then why is it so precious? Oh, I'll say memories in my head, like Polaroids on walls. They remind you to look ahead. Time is running out. Time is running out. Lately I've lost my track. I've sailed the deeper seas, hoping to find something to bring back better times. Oh, I'll say memories in my head, like Polaroids on walls. They remind you to look ahead. But time is running out. 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 Time is running. Time is running out. But time is running out. What if my best days are over? They can be over. They can't be over now. Time is running out. What if my best days are over? They can't be over now. Time is running out. Time is running out. Time is running out.
Good morning, everybody. Welcome. Paper one is out of the way. Micro is done and dusted. We'll come back to it, obviously, for the synoptic paper. So our attention today is going to focus on macro, which is on Monday. And we have two live streams lined up for you, a UK focus today, an international focus tomorrow. And also at the end of tomorrow, we'll have a sort of short Q&A session where you can ask questions about your macro paper. So welcome, everybody. If you are watching live, make sure you're subscribed to the channel along with 1.3 million other people, so you can contribute to our amazing live chat. We have an incredible group of students, and let's make a start. We're going to look at the UK economy today. I've got a little something slightly different for you here. I've got 5 charts, all on the UK economy. Can you name the chart? It's something slightly different. Some of these are quite hard, by the way. So here's your first chart. We're looking for a precise answer here. What do we think? Most people coming in pretty quickly. Jack says it's immigration from non-EU countries. Not quite right. Most people have it right. The answer is Bank of England, base rate of interest. Correct. Pardon me. So that's the base rate of interest, 5.25%. So lock that number in. That's the easy one. Let's have a go. If you can get 5 out of 5, by the way, this is seriously impressive. Here is number 2. Name the chart. If you played Name That Tune, you'll want to play Name the Chart. What do we think here? So Freddie's saying GDP, KS saying unemployment, Oliver saying corporation tax, somebody saying the exchange rate. We have the correct answer from Jack Seaborn. Well done, Jack. Fantastic answer. I think you were the first person to come in, specifically Dan Bailey as well. The answer is youth unemployment. Now there's Dan's answer. She's correct. but Jack Seaborn was the first correct answer. Quick reminder there that youth unemployment is 12% in the UK, pardon me, which is 3 times the adult rate. Number 3. Oh, okay. Will says, if I get on the chat winner today, then paper 2 will go well. Well, there you go, Will. You've achieved it within the first 2 minutes. Chart number 3. Now, this is harder. If anybody gets this, you should get an A star by default. The different colours are that 24 onwards is a forecast. And I quite like that colour. So there we go. Can anybody name? So Harry says growth. Jack says bond yields. There we go. This is for the UK. Ben says potential GDP growth. Really good shout, Ben. The trend growth of the UK. Really good shout. You're quite close. It's not quite right. Forecast growth from Matt. Bond coupons, bond yields, the fiscal deficit. What do we got? Increase in tax revenue, the inflation target, which we think is 2%. Fiscal headroom, says Harbier. I think I've beaten the entire group. Dorothy says FDI is a share of GDP. Wow. Fantastic. Shout out for Miss Begums, who allowing her class to watch this. It is in fact, I think I've beaten the group. This chart, in fact, is UK's share of global GDP, shares expressed at PPP. Now, the reason for showing this chart, keep in mind for paper 2 that the UK economy is not a particularly large economy. Its share of global GDP is declining. We take about 2% of the world economy. Put that in context, the whole of sub-Saharan Africa has 3% of GDP. Lucas says it's percentage of people who support Harrogate Town. Not quite right. And it's great to have the Nobel-winning prize-winning economist Paul Krugman in the building. Welcome, Paul. Great to see you. Name the chart here. Now, I think this could be a chart for the exam. I don't know. It could well be. This can you name the 2 charts? The one in blue and the one in a lovely shade of grey. What do we think? What do we think here? Blue and grey. So if you can get both of them, Florence says inflation and deflation. Not quite, but pretty close. I'll give you a clue here. The grey line is inflation. And Gregor Davis. Well done, Gregor. I think you were the first person to get the right answer. Fantastic answer. Well done to you. Here it is. It's wage growth and inflation. Will you get an inflation question, a wage price spiral question? Something on the Phillips curve? Emily came in with the right answer as well. So basically that's nominal wages rising, accelerating, but well below inflation in 2022. That was the real wage squeeze. Evidence of a wage price spiral, but not necessarily stagflation. Right, one more to test everybody. We have over 350 people in the live stream today. So welcome if you're new to our sessions. Again, can you name the 2 charts here? You've done incredibly well. I beat you on one of them. I've got a feeling I might beat you on this one as well. So Will Croft says migration into the UK. Great idea, Will, sort of net. So Ricardo says the budget deficit. What are we saying here? People saying GDP per capita, average income. Johnny, I think Johnny has the right answer. So well done to Johnny, the first person I can see in the chat window with the right answer. If we put the answer up on the screen, it is indeed real mean and median income. But that is super important that you know the difference for paper 2. Really important. And as you can see, that gap. Oh, John says Harrogate Town's goals scored and conceded. Correct. Is that over the course of a season, John, or my lifetime? And congratulations, by the way, to John on winning a place to Clare College, Cambridge, which is my alma mater. An amazing place. Well, okay, a bit of a different sec. Very quick, let's move on. Can we lock in this data, please? So lock in. These are the figures you want to take into the exam. I feel like I sound like a well-known YouTuber. Here, let's smash the exam with this data. Inflation 3.2%, having peaked at 11%. UK economy only grew by 0.1% last year, a fairly shallow recession. Base rate is 5.25. Unemployment edging up now, it's 4.2% of the labour force. The yield on government debt is 4%. it's a little down on where it was this time last year, but it's about 4%. The pound's gone up. The pound is now worth about 127, 128 last time I looked. And of course, you've got GDP per capita, $46,000, but it's bigger in the States and even bigger in Ireland. Of course, a lot of that is linked to multinational investment. We've got some new people in the chat today, some new people, it's great to have you. Quick reminder, of course, we have an amazing group, an incredible group who just support each other. So keep the comments civil and decent, and then we'll get on well together. Here's the next lock-in slide for you. The budget deficit last year was 4.5% of GDP, which is a long way down from 2021, of course, which was the year of furlough and the collapse of GDP. National debt, 98% of GDP, 2.4 trillion. The highest tax burden for 70 years, 38% of GDP. We're running a big trade deficit. We have a 3% current account deficit. We're going to talk about that today. We're dropping in competitiveness rankings, and we're 15th on human development. There we go. If you want some key stats to impress the examiners with, there they were. Okay, so Harmer says, do you lose marks if you don't use figures? Well, in the daily response, yes. Because as I said to you, if there's data in the extracts, there has to be data in the answer. In the 25 markers, I would be hoping that good students, well-aware students, will be able to add in, sprinkle of such as macro data into their paper. You don't need a lot of data, just enough, and hopefully this session will give you some. Okay? Right, over to our group. So we're coming towards the end of our live streams. We had about 30 of them. We've probably got 3 or 4 left. We'll do some synoptic revision, but we've got 2 macro. Those of you who are new today, we have an amazing group of students who are just brilliant at contributing answers. So I've got 4 questions for you, 4 topical issues that I think could come up on Monday. First of all, the pound is higher. The pound fell to nearly £1 equals $1 in 2021, but it's obviously risen since then. Can you give me 2 impacts, please, on the UK economy of an appreciation of the sterling exchange rate? Have a go. So 2 impacts, not 2 causes, but 2 effects. So with macroeconomic indicators, you can go a long way in the exam by thinking about cause and effect, as well as on policy. So the pound has been rising. It was $1.06. It's now up to $1.27, 28. Not as high as it was back in a few years ago, but it is appreciating. Thanks to Illy for the answer coming through there. Yep, Hannah links very tidily the impact on imports. So perhaps in consequence for the exchange, for the trade balance. What I would add there, Hannah, is the word net trade balance. With a good answer. Oh, superb answer from Max here. Depends on the pattern of trade. If our exports are price inelastic, imports price elastic, then it should improve. So a lot of you talking about the current account deficit and loss of competitiveness, which is a really good point. If you're linking the exchange rate to trade and current account, that's gold dust when it comes to macro policy. Ed talking about a loss of competitiveness. In price terms, yes, of course, non-price factors. All good. Harbour talks about appreciation power, make American goods cheaper. Larger current account deficit. Yeah, Jacob Bickerstaff. Just pick up Jacob's answer, which is a really subtle, important answer coming in from Jacob. If we can find it, here it comes. Harm UK service exports to the United States. Much of these were driven by outsourcing by US firms in light of a weak pound, legal services and consultancy. Indeed, a lot of, So there could be some sort of trade diversion effect, really, that some outsourced service industries, which are already under threat from AI, to put it bluntly, might tip to another country in the light of the rising pound. They might shift towards Western Europe, for example. Quite a few of mentioning the J-curve effect. Here are my 2 answers. I've gone for trade, but actually the first one I would link to disinflation. So keep in mind, you're taking the exam on Monday, and inflation has fallen from 11.1% in October 2022 to 3.2% now. It'll fall further in May, but after your exam. So this is a really key point. So a strong exchange rate helps the process of disinflation. See, anything priced in dollars will become cheaper: oil, gas, copper, cocoa, cement. And of course, if that becomes cheaper, there's an outward shift of short and aggregate supply. Ceteris paribus, not everything else is the same, a fall in inflation. And if that happens, that might encourage the MPC to start cutting interest rates. So if you were linking the rise in the pound to a fall in the rate of inflation and a potential fall in interest rates, that is quite sophisticated analysis for paper two. But many of you did talk about a worsening of the current account, assuming the Marshall Lerner condition is felt. So a stronger pound could improve the current account initially. So with that answer, you go with inflation and trade. That will be your 2 KA points. Okay, and then challenge and question. Good stuff. Let's move on. So something that's been lightly examined in recent years is the balance of payments, but the current account. This chart shows the UK current account up to the spring and summer of last year. Because you won't get the latest data. You can see here that most of it is negative. Have a go at this one for a minute. And just going to pop off for a second. Can you give me 2 impacts on the UK economy of a persistent current account deficit? Again, with these macro things, it's cause, effect, and policy. I think Liam was mentioning in the chat beforehand, questions about current account. What's causing it? What are the effects? And what policies might address it? Great answer there from Lara. Great answer. Really good answer. Linking to unemployment, long-term industrial decline. Yeah, superb stuff. Oh, wow. Harshini talking about because dissuade the FDI from the UK could emphasise the increase in north-south divide. Yeah, particularly, I think one of the impacts depends what's causing the deficit, doesn't it? If it is the result of regional economic decline, the long-term contraction of key export sectors, really good stuff. Quite a few of you talking about fiscal deficit. Be careful here. The current account is very different, the trade balance, very different to the fiscal balance. So please avoid that conclusion. So Shandy talking about working export competitiveness, damage to exporting firms, higher national debt. Conceivably, you'd have to put in a couple of links in that chain to get to national debt going up. Exporting firms make less profit, for example, employ fewer people. So tax revenues go down. Let's go through my answers because this is super important. The current account. Please do revise the trade balance, the current account for Monday. The obvious point, but it's obvious, it's still worthwhile, is that a current account deficit is a net outflow of aggregate demand, if it's dominated by the trade deficit. So it's 37 billion trade deficit. So there's a net imports greater than exports. That then leads to weaker growth because M is greater than X. And indeed, if you link it, many export businesses in the UK are now saying they're finding it harder, more expensive to export to the EU. Services holding up well, but exports of goods have really struggled in recent times. So then you can then link to a slowdown in exports and the impact on planned investment and jobs. The other more subtle A-level point, which is really AA star point, is that if you're running a current account deficit, effectively you become an external debtor nation. And so basically you have to finance it by attracting net inflows of capital on the financial account. Now that could be hot money, it could be people buying UK government debt, it could be people putting money into the UK stock market, it could be the UK companies being bought up by overseas entities, overseas TNCs. In the long run, countries that run big current account deficit tend to sell assets, including businesses and bonds, to overseas investors. Now, if you're happy with that, that's great. But if you want the post office, the Royal Mail, to be bought by a Czech billionaire, then I don't want that to happen. But that would be a net money inflow on the financial account into the UK. The current account, Harry, is the balance between goods and services, primary and secondary income. The second point, let me just go again. So if you're running a current account deficit on the current account balance payments, you have to balance your payments up. You have to attract inflows of financial capital to balance your account. So, for example, UK is a current account deficit country. We have to inject capital from overseas, which we do. We're attractive to FDI. If you're running a current account surplus, you can lend to other countries. Norway, Singapore, China being good examples. Okay, good stuff. Next topic. This is again a lightly examined topic just in the last few years. I think particularly for AQ and Edexcel living standards. So over to you. Can you give me 2 limitations of using real GDP per capita as a measure of living standards? Over to you. Essentially on that previous point, if you're an external debtor nation, you have to borrow from overseas. And the UK borrows by getting foreigners to buy UK government debt. So here we go. So per capita incomes. Ben says it doesn't account for the income distribution. Excellent point there from Ben. So many of you are saying it doesn't account for income inequality. Johnny goes a little bit deeper, talks about regional pay gaps, regional per capita income differences. It's good stuff. Labu 277 doesn't take into account subjective topics such as happiness. We'll talk about that in a second. Great point. Emily goes down the sort of sustainable growth idea. It doesn't include environmental and negative externalities. China's high growth rate, but obviously impact on natural capital and also the informal economy. So looks like people are pretty clued up on this, which is good. Excellent stuff. Here's my answers coming up. There's so much you can talk about here. I have gone for inequality and social welfare. So GDP per capita ignores distribution issues like income inequality and poverty. In the chat before our live session, people were mentioning things like the Gini coefficient and the Palmer ratio, the SATS20 ratios. The UK, of course, has significant issues with working poverty, people who are in work but poor, fuel poverty, and it has one of the highest levels of child poverty amongst rich nations, something like 4 million children. And then social welfare. So GDP measures what you can measure, because it sometimes measures what matters. So it doesn't really account for non-market activities, volunteering, caregiving, household work. Many of you may well be in families where one or more people care for a relative. And the value of time and effort and expertise and patience in that isn't counted in GDP. And as Emily mentioned, it doesn't account for environmental degradation and other negative externalities. So GDP per capita is a pretty narrow measure. You sometimes want, if you want a word, a more holistic measure of well-being and welfare, which leads me on to my next question. Yeah, Jack says working poverty is such an easily applicable concept for A-star gold. It is, particularly if you, in paper 3, potentially if you get a question on labour markets and minimum wages, that kind of stuff. Okay, so moving on to the next point. People saying, what's the Cole-Palmer ratio? It's the ratio of goals to minutes. It's 1 to 1, isn't it? Can you give me 2 alternative measures of living standards or well-being in the UK? Have a go. So you need to be able to criticise GDP per capita, but can you also take it further and give me 2 alternative measures of living standards in the UK? A lot of people coming in with HGI. My instinct is probably not to use HGI because that's mainly a measure of development, but you can use it. It'd be accepted by the example. That'd be fine. GNH, gross national happiness. Quite a few using multi-dimensional poverty indices, which is excellent. Dan Lex talked about the Happy Planet Index. Yeah, there's Will's answer, multi-dimensional poverty index, and also the genuine progress indicator, which is an environmental indicator. Oscar goes for HDI, GNI, life satisfaction index, all good. You do need to have, the Snack Bandit, who's just finished CIE paper 4, so congratulations to him. Just gives a little look at the multi-dimensional poverty index, which will be super useful for any development question. It measures deprivation in terms of infant mortality, access to clean, safe water and sanitation systems, healthcare, access to early education. UK as a developed country will show, well, it does, although there's a lot of poverty in the UK, much of which lies beneath the surface. Often is beneath the surface. Here are my 2 points. So I've gone for subjective wellbeing measures. Now, Edexcel fans in particular, they have asked questions on this. So the usefulness of data on life satisfaction, people rating their overall happiness, the reported feelings of happiness, anxiety, job security, financial insecurity, those kind of measures are now published. And really importantly, linking back to what we did before, median real disposable incomes. So we tend to use the median income when the data, as in the UK, is skewed. So people on super high incomes that drag up the mean. And there's now a £6,000 gap between mean and median real incomes, household incomes. That is a big gap. G9 says, can you use the relative poverty rate to measure living standards? Yes, undoubtedly. So what you could use there, G9, is the percentage of households living below 60% of median income, adjusted for household size. And that is a relevant and super measure to use. Great stuff. We're doing super well here, everybody. Hopefully you're finding this useful on macro warm-up. Let's have a look. Oh, I just wanted to show you this chart because the new data came out yesterday. I haven't been able to update the chart. I will do, but this is the number of people using food banks in the UK. It's a reminder that macroeconomics has micro foundations. That you can measure GDP per capita as much as you like, and you can measure unemployment, and you can measure the budget deficit and base rates of interest. But what matters to most people, day in, day out, is whether they have food on the table and whether they can eat properly and feed their families. The Trussell Trust, this data comes from, shows that last year over 3 million people used food banks. That is one for thinking about. Okay, so moving on. Yes, let's finish with this topic. Now, again, topical issues. Corporation tax was 19% actually for 5 years, from 2017 to 2022. Then the government raised corporation tax, and there was a little hiatus. The Prime Minister and the Letters had a bit of a battle, but the government then raised the main corporation tax rate to 25%. For firms with profits over £250,000. They kept the 19% for smaller companies. Okay, I've just given you also some data on corporate tax rates last year in Europe in selection of countries, including Germany, Poland, and Ireland. Can you please give me 2 macro effects of a rise in corporation tax? Have a go, please. So this is our last question today. 2 macro effects. If you can, add a little bit of evaluation in there. Lucas linking neatly there to Ireland, which has a lower percentage corporation tax rate. Good, great point, Lucas. Presumably then throw in the Laffer curve at that point. Whitley Bay says companies leave the UK. Tom, yeah, great point from Tom there. So if FDI goes out, it makes it harder for the UK to finance the current account deficit. Great point from Tom there, Tom Reid. Emily says that corporation tax might be passed on to consumers. I'll come back to that point in a second, Emily. We have to remember, please, that corporation tax is not a cost of production. It's tax paid ex post after the event. It's paid a year actually in arrears. So the profits that Chitaju might make in 2023, we pay a year later in corporation tax. So there's no obvious reason why corporation tax going up should cause higher consumer prices, because it's not a cost of production. Although the exam board don't seem to understand that. How it talks about more tax revenue for the government. Yeah, absolutely. Fewer firms basing themselves in the UK to avoid paying higher taxes. Good stuff. So, and in theory, corporation tax going up will drive revenues higher. JJ Foster crowding in. An increase in corporation tax increases government revenue, increasing government spending. because if the private sector will see an increase in investment as public sector is funded. So JJ unleashing his inner Keynesian there, talking about crowding in. Of course, it much depends there on how the revenue is spent and how much extra revenue is generated. So Jasmine talking about fiscal dividend there. Some good points, really good points. Here are my 2 points just to finish with. I've gone for 2 negative ones, but I've evaluated. Let's take a moment on this if it's okay with you. Fall in planned investments. So higher corporation tax reduces the post-tax profits the firms make and might lead, hedging word, might lead to businesses having less internal finance to fund capital projects. The evaluation is actually a compensating policy. The government has now cemented and made permanent 100% tax allowances. So if you spend £100,000 on new equipment, you can, and you're a large firm, you can claim 25% of that against your tax. So essentially, if you build new factories or buy new machinery, the government now gives you a 100% tax allowance. Doesn't mean it pays for your equipment, but you can claim 25% off the tax rate. So there's a nice compensating policy. A risk of a fall in tax revenues, encouraging legal tax avoidance using transfer pricing and profit shifting, ultimately reduces the flow of tax revenues. The evaluation is, you've got to see it in the context of measures to avoid avoidance. Avoid avoidance, if that makes sense. So there's now hopefully going to be a minimum corporation tax rate of 15% coming in at some point. And keep in mind, of course, that investment doesn't just depend on corporation tax. It depends on the speed of technological change, competition in the market, rate of economic growth. Many factors drive investment rather than just the rate of corporation tax. But some great answers coming through in the chat window. So well done. There we go, everybody. Thought I'd just do a quick UK focus today with some charts, the lock-in data slides, and 4 topics I think are super topical. What did we cover? We covered exchange rates, the current account, we covered corporation tax, and we covered per capita incomes. 4 lightly examined topics which may well feature on your macro paper on Monday. Tomorrow, we'll do a half an hour or so on the world economy, international economics, tariffs, quotas, balance of payments, maybe a bit more development. We'll do some development economics. So if you can join me tomorrow at the regular time, 11:30, you'll be more than welcome. For now, thanks for joining in. Big thanks to our production team who work behind the scenes to make these things run smoothly. Stay happy, stay positive, stay curious, and see you sometime soon.